Hello and welcome to the second half of the Chapter 9 lecture where we're talking about receivables. We spent all the time on the first lecture talking about accounts receivable, and in this one we're primarily focused on notes receivable with a couple of things thrown in at the end. So with a notes receivable, it's different from an accounts receivable in that there is an official promissory note. An official promissory note is a written promise to pay. Not only will the customer be paying us the amount that they purchased or the amount that they borrowed, they're also going to pay us interest. This interest is usually given to us as a stated annual rate. For now, we're focusing on short-term notes receivable. And with the short-term notes receivable, we're looking at notes that are less than 1 year. So we may have to convert this rate to a fraction of the year, but always keep in mind that the expressed rate is an annual rate. Notes receivable is an asset, just like an accounts receivable. And there are a couple of important things that we need to deal with when a note is created. The maturity date is the day that the principal amount, or the amount that was borrowed, plus the interest needs to be paid back. For this example, this note was issued on July 10th, and it's due in 90 days. We can calculate the actual date that the note matures. So matures is just a fancy way of saying it's time to pay up. And we determine that the maturity date is on October 8th. I won't ask you to do this. If I happen to give you a problem and they ask you to determine the maturity date, just skip that part. So when the note matures, the interest will be paid back, and we need to compute the interest. We take the principal amount of the note, which is the amount that was borrowed. We multiply that times the annual rate of interest, and then we multiply that times the fraction of time. Usually this is the number of days of the note divided by 360. Yes, I know there are 365 days in a year, but we use 360. It's the banker's rule. It makes life easier because sometimes there's 366 days in a year, so we just use 360. So on this particular note, the amount of interest ends up being $30. So when the customer pays us back, they're going to pay us $1,030. Now, I'm itching to see some journal entries. Let's see some journal entries. On the day the note is received by the company from the customer, the company is required to record a notes receivable. So to illustrate the recording, we're going to use that $1,000 90-day 12% promissory note from Julia Brown to TechCom. We are TechCom. We debit notes receivable for the $1,000, and this was for a sale. So we credit sales. Sometimes notes receivable can be issued to extend an accounts receivable. So if an accounts receivable can't be paid off within the 30 days and the customer needs more time, then we may issue a notes receivable and require that the customer pay us interest at the end of that notes receivable. We don't do anything with interest on the day the note is issued. So we hold off on interest. Now, in this example, this is what I was talking about when a company will accept a note when the customer can't pay off the accounts receivable. In this situation, the customer had an accounts receivable of $832. They were able to pay $232, but the other $600, they asked for a notes receivable, or a notes receivable was issued. So in that situation, we record the cash coming in. We take the accounts receivable off the books, and we put the notes receivable on. Now, what happens when the note gets paid? When the note gets paid, the accounting term for that is the note is honored. When the note is honored, this is when we deal with the interest. We record the amount of cash that we are going to receive. And that cash is the principal amount of the note plus the interest. We take the notes receivable off the books. So we end up crediting notes receivable, And we record the interest revenue. We credit interest revenue. The sum of those two equal the debit to cash. If when a note is paid, it's honored, then when a note is not paid, it is dishonored. When there is a dishonored note, instead of receiving cash, we convert that note's receivable into an accounts receivable, which means the amount is essentially due immediately. And not only the amount borrowed, but the amount borrowed plus the interest. So this entry looks essentially the same as when a note is honored, only instead of debiting cash, we debit accounts receivable. Now, what happens when a note crosses accounting periods? So the note is initially recorded on December 16th here, but the note won't need to be paid until sometime during the next year. In that situation, there is interest that we have earned, but we haven't received and we haven't recorded. Hopefully that language sounds familiar to you because that is an accrued revenue. In other words, there is an adjusting entry that we need to do here. So on December 16th, TechCom accepts a $3,000 60-day 12% note from a customer and granting an extension on a past due account. When TechCom's accounting period ends on December 31st, $15 of interest has accrued on the note. So on December 16th, we would have debited notes receivable for $3,000 and credited accounts receivable to take the customer's accounts receivable off the books. Time passes. This is a 60-day note, so it's not going to mature until sometime in February. We get to December 31st, and there is interest that we have earned. We have to count how many days there are from December 16th through December 31st, not counting the first day. So don't count the first day. The easiest way to do this is take the difference between 31 and 16, take the difference between the dates here, and we come out to 15 days. We're going to take the principal amount of the note times that annual interest rate and multiply it times our fraction. Not 60 over 360, but this time 15 over 360, because we only want to know how much interest has accrued from December 16th through December 31st. So we debit interest receivable and we credit interest revenue. Now, once we collect the note, we do need to debit cash for the principal amount of the note plus the interest, and then we credit all of our other accounts. We have to take notes receivable off the books. We have to take interest receivable off the books. And we also need to record the additional interest revenue that has accrued from January 1 through February 14th. We can find this in a couple of ways. We can take the 45 days and divide that by 360 and then plug that into our interest calculation formula. Or we can find the total amount of interest by taking the 60 over 360. And then we can plug that into our equation, find the total interest, and subtract out the interest that we have already recorded. So when a note crosses accounting periods, when the note gets honored or dishonored, the entry changes a little bit because we have already recorded a portion of the interest revenue so that we don't violate that matching principle. Now, companies are allowed to dispose of receivables early. Suppose they can't wait for their customers to give them the money. They need the money now. Companies can sell their receivables. That's known as factoring receivables. Or receivables can be used like any other asset as collateral to debt. There are different journal entries for that. The journal entries are beyond the scope of what I need to teach you for Accounting 1. If you're an accounting major, you'll see it again in Intermediate 1. If you're a non-accounting major, just know that companies can convert their receivables to cash early through selling them or through using them as collateral on a loan. There are some ratios that we can calculate to help us determine how often we collect on our accounts receivable. And that's the accounts receivable turnover ratio, where we take net sales and we divide it by average accounts receivable. So how efficient are we at getting our customers to pay us on time? Whether or not the number is good is really dependent upon the industry standards. It is dependent upon our credit policy. In this case, it looks like Visa is able to turn over their receivables 16 times a year, so more than, looks like a little less than once a month in this situation, where MasterCard can collect less than once a month. More than once a month, excuse me, because it's 7.4. So 7.4 times a year, and that's, again, 16.9 times a year. All right, that is the end of chapter 9. Take a look at the walkthrough video where I'll do a couple of problems on notes receivable with you. Again, I so appreciate your time and attention, and I hope that you have a wonderful